Hello YouTube, I am Kevin, a CPA, and I wanted to share my experience with the stock market. So, when I first started investing in the stock market back in 2017, all of my stocks were going through the roof because the entire stock market was bullish. However, the trade war, the COVID-19 pandemic, and the Ukraine war made the stock market so unpredictable that I sold all of my shares. A majority of them were sold at a loss. It was at this point that I wondered, how do I predict the stock market? And that is when I read Ray Dalio's Principles for Navigating Big Debt Crises. Ray Dalio is one of the few who predicted the 2008 financial crisis using his principles in his book. Principles that you can use to anticipate the next financial crisis. In his book, Ray Dalio taught me that debt determines the direction of the stock market and the economy. We use debt to create more jobs and buy more products. However, eventually, we borrow more than we can repay. It is human nature that makes debt crisis inevitable. In his book, Ray Dalio gives an in-depth explanation on what happens during a big debt crisis, highlights warning signs of an upcoming debt crisis, and lists several examples of such crises. A long-term big debt cycle consists of multiple short-term debt cycles. The difference is the conventional tools of the Fed are enough to help the economy recover in a short-term debt crisis, but not during a long-term debt crisis. Ray Dalio breaks the big debt cycle into 5 parts: the early phase, the bubble phase, the topping phase, the depression phase, and the beautiful deleveraging phase. During the early phase, there isn't too much nor too little lending. Most borrowers can pay back the debt, thereby making the total debt in the economy sustainable. During this period, the economy and the stock market are growing. The bubble phase is when debt rises faster than income, thereby accelerating growth and stock prices. The phase is a self-reinforcing cycle that inflates the bubble. It starts when buyers borrow money to spend more than their income. Since one man's spending is another man's income, the seller's income increases, thereby allowing them to borrow even more. Then the cycle continues again and again with different parties. The cycle is further aggravated when the Fed sets interest rates low, thereby making it cheap for everyone to borrow. While all this is happening, business sales continue to increase, thereby making their stocks more valuable. As their stock becomes more valuable, more people want to buy their stock, thereby increasing their value. As more people buy their stock to avoid missing out, more stockholders will use margin loans to further push up their stock price. Ray Dalio does list several signs of an existing bubble. One being new buyers such as the Robinhood retail investors and the bottom 20% of income earners during the 2008 housing crisis. These new buyers are not aware of the risks in the market, so they tend to follow the crowd and don't know what they're doing. Another being the broad bullish sentiment in the public, such as the 2021 overly optimistic economic outlook before the inflation news, or the quote-unquote riskless mortgage-backed securities. Because there will always be a risk, there is no such thing as a riskless investment. A third sign is monetary policy that inflates the bubble to the point that a reverse could pop it. Usually, low interest rates encourage borrowing and inflate the bubble. When the Fed starts raising interest rates, the bubble can pop in the form of debt defaults. No single metric can tell us whether we are in a bubble, but multiple metrics can. The topping phase is when the bubble starts to pop, whether it's due to the bubble itself or an external reason. The Fed starts to raise interest rates to tighten the money supply. Although the economy is slowing down, we still hear news of the stock market breaking record highs in the early part of this phase. Eventually, the yield curve becomes inverted. While the yield curve is inverting, some of the riskiest debtors start struggling to make their monthly payments, thereby worrying lenders. As a result, money is moved from the riskiest assets to safe assets. Basically, money is being pulled from the stock market, thereby sending the stock market down during the latter half of this phase. The depression phase is when the self-reinforcing cycle becomes reversed. Instead of borrowing money, many buyers are instead cutting spending to pay their debts. As spending gets cut, other people's income start to decrease, and the cycle continues with other parties. For companies, they are seeing less sales due to less spending in the economy, so their stock tanks and they start laying off people. As the stock decreases, more people start selling their stock. If it decreases enough, banks who lent margin loans will force sell the borrower's stock just to get their money back. When the buyers cannot make their monthly payment, they start to default on their debt, leading to deflation in the economy. While the crisis unfolds, the government is trying to make the debt burden more tolerable, preserve asset values, and save the financial system. The Fed cannot lower interest rates because it's already at or near 0%, so they would need another method of stimulating the economy. In the case of 2008, the Fed printed money to buy mortgage-backed assets to balance out deflationary pressures with inflationary ones. Assuming the government uses the right amount of stimulation, a country enters the beautiful deleveraging phase, where the economy is recovering faster than debt, without too much inflation. Since the economy is growing, the stock market is also rising. No debt cycle will play out exactly like Ray Dalio's model, but it's a good tool to predict the future. When inflation is above 2%, start selling your stocks. When the Fed starts stimulating the economy by lowering interest rates, start buying stocks. As you can see, his model helps you to buy low and sell high based on monetary policy. However, this video only gives you a summary of Ray Dalio's model, whereas his book can provide the full experience needed to complete your understanding. Thanks for watching. If you enjoyed this video, be sure to leave a like and subscribe. I am Kevin signing off.